Matt Matros, welcome to Built to Sell Radio.
I appreciate you having me. This is awesome. Your listenership is great, and I hope I can add some value today.
I think you will. You have started and exited 3 companies, and we've chosen to focus in on one called Protein Bar. So I want to jump right to that story. And at the end, we'll talk a little bit about what you're doing now. But let's jump into the Protein Bar story. For folks who don't know it, what was Protein Bar? What is Protein Bar?
Yeah, Protein Bar, it started as the quintessential small business. It was me raising SBA dollars. I shouldn't say raise, me getting an SBA loan, taking all my entire life savings and running up my credit cards to open a smoothie shop right across the street from the Sears Tower in Chicago. The premise was, this was late 2008, and the premise was sugar is bad for you. And pretty soon people are going to realize Jamba Juice and a lot of these fruit smoothies aren't that good for you. And I was right, just many years ago. So I took all my life savings, started the first protein bar across the street from Sears Tower. Again, started as a smoothie shop selling mostly protein shakes. Out of mere survival, I had to pivot to adding food to the menu, which I did about 7 months in, and then things just took off. Met customers while working in the restaurant and opened a second and a third and a fourth and a fifth. Ended up opening 30 of them across the country. And then along the way, ended up selling the majority of the business to a preeminent private equity firm called L Catterton.
Okay, we'll get to that in a second. I just got a few questions about protein bars. So you added protein, food. So like kind of bowls and sandwiches, that kind of stuff?
Exactly. So picture you're roughly the size of a Starbucks or a Chipotle. So it's a fast casual restaurant. Locations now mostly in Chicagoland. We opened in Salt Lake City Airport and have one coming up in LaGuardia Airport. But it's a smoothie shop, sort of like in the vein of a Sweet Green or a Kava. So fast casual with protein shakes, bowls, salads, and the like.
Got it. Excellent. And as you grew, you mentioned you met customers who wanted in. Did you use a franchise model, or were they all company owned, or how does that work?
For me, it was all company owned. We've just now started franchising. And I say we, I'm still the second largest shareholder, no day-to-day involvement, but still close to the business as a fan and a customer. And I'll always be the founder, right? For folks listening, you'll always be the founder of your company. We did not. We chose to company own each unit just because the cash on cash returns of each unit made more sense to franchise it. To me, franchising was sort of the F word. I didn't like it for a few reasons. Obviously, my tune has changed, but at the time, I just didn't want to share the economics with someone else. I didn't need to. Like our units were doing 40% cash on cash return, which is great. So I didn't need to share those metrics. 2, I'm a control freak. I care about each and every detail, right? So I didn't want to give that up to another person. And 3, I believed, and I'm not saying this is true of all franchises, but I believed at the time that the guest experience was better in a company-owned environment. Now, when I was growing Protein Bar, this was in the age of Chipotle, which was competing with Qdoba, and Qdoba ended up dying, and it was mostly franchised. And Starbucks was growing and competing with Caribou Coffee, and Caribou Coffee died, so like all the franchise operators tended to not make it. So at the time, that was my thesis. Now, obviously, I shouldn't judge paint a broad brushstroke on all franchise operators, but to answer your question specifically, we were a company.
That was the specific. Yeah. And refresh me on what you mean by a cash on cash return. I don't know what that means. So describe.
Yeah. So in retail. So when you open up a unit, in retail, it's all about the return on invested capital. So the amount of money that it takes to get that thing open, essentially how quickly do you pay it back? And in multi-unit retail, you want to be about 3 years or better. So if it's gonna cost you $1 million to get it open, you want to be doing about 333 of profit, EBITDA, cash flow, however you want to measure it, a year, such that you pay that thing back in 3 years. That's kind of the restaurant level, multi-unit level economics at the time.
Got it. Okay.
And we were doing much better than that. We were paying some stores back in a year. Some stores back.
Okay. So this was working well. What was the trigger to make you want to take on outside capital? So maybe let's walk through the L Catterton acquisition. What precipitated that?
Yeah, so it was 2012 and Protein Bar had just opened. I just opened a location in Washington, D.C., and it was wildly successful. So I got pretty lucky because in 2012, I was sort of the hot girl at the dance because three things were hot and I was all three of them. So specialty retail was hot, which, you could argue quick serve restaurant is specialty retail. Container Store had just gone public, and there was a number of other multi-unit retailers that had just gone public. Quick serve restaurant was number two. That was hot. So Potbelly was about to go public. Doodles and Company had just gone public. So quick serve retail was very hot. And health and wellness was hot. And here I am, Protein. We were all three of those things. So when I opened in Washington, D.C. and proved that it wasn't just the Chicago thing, I had proven portability, that's when all the private equity firms came calling. Because they're like, wow, this guy's got something pretty special. Let's put gasoline on the fire.
So interesting. So it was the launch outside of Chicago, the proof that it would work in a different geographic market.
Exactly. It wasn't just this homeboy thing in Chicago. And that's when all the groups came calling. And I was pretty fortunate. I had the pick of the litter, so to speak. I had 4 or 5 groups, which all of them I really liked. And it just so happened that L Catterton was the group I liked the best.
Where are you revenue profitability wise at this point?
At that point, we were, and it's hard to say revenue and profitability just because you had stores that were newly opened, not newly opened. But at that point, we were probably about a $12 million total company.
Mm-hmm. And profitable or
profitable? Oh yeah, because each unit's making money, right? And our corporate overhead was very lean because we were a small team.
So what would you put to the bottom line on the 12?
The reason why it's not so upfront to answer is because at any given time I had 8 stores that were sort of in various levels of development. So
you're pouring all the excess cash into the development of new
correct.
stores.
So it's not as simple as like what was, but on a P&L basis, I mean, probably 20%, right?
Right.
So 20% of $12 million was my sort of like store level contribution margin. But we were all growth. This was the J curve. When you think about,
what do you mean by J curve?
Think about the J curve, right? If you think about time as 1x, one element, and profit as the other, when it was just me in a blender, we were super profitable, right? Then we start growing, so time goes and our profit dips. But then at some point we start, outstripping our fixed costs, leveraging our fixed costs because we're opening more and more units. We were in that dip because we were fast growth. That's what led me to private equity. So to answer your question specifically is like why private equity even made sense for me. Because for me, I was in a race. It was all about speed. I could continue to open new stores from cash flow, but I wanted to open thousands of them. I didn't want to just open ones of them.
That strikes me as somewhat contradictory. I'm sure there's an explanation, but help me out. You said you're a control freak. You like every detail. You want company-owned stores. A lot of people that are like focused on hyper growth would have been the opposite, right? The details don't matter because we want to grow and scale. And franchise is so much faster than like company-owned because we can get the the franchisees to finance their growth. So help me understand what appears to be a contradiction. On one hand, super focused on the details. On the other hand, wanting to grow. So what was it about growth and that was so important to you? Why not keep it a relatively small, successful business?
To be honest, because that's the type of founder that I am. I tell this story a lot, and I won't say the operator, but in Chicago, there's a sandwich operator who I know pretty well. And when I opened Protein Bar, he had 4 locations that were doing great. And I opened my first one. Fast forward 5 years later, I had 10 locations and he had 5. Now, does that make me a better operator or entrepreneur? No. Just because I have more units doesn't make me better. It just means I chose to dilute myself along the way and raise money. He owned 100% of his company. He had 5 stores. He had 100% of the company, and maybe he'd been in it, a bunch of years longer than me. It just speaks to the DNA of who I am, and at the time, who I was. I wanted to go fast. So why private equity? Multi-unit retail is just stamping units, getting new units open. Now where Sweet Greens of the world and the multi-unit retailers of the world mess up is that when some of the units don't work as planned, it kind of gunks up the flywheel. And that's sort of what happened with Protein Bar. I had 12 locations open. I had another 8 in various stages of development. I needed to pay for those 8. Now I could raise, but store by store by store by store. But because I was so hot at the time and had everybody coming at me, I knew that was kind of the strike while the iron's hot kind of moment. A lot of people will ask themselves, when's the best time to sell? And I always say that the best time to sell is when you have that first real inbound request. And I don't mean first inbound request by some schmo search funder or some inbound request by a competitor. I mean like a first real, this guy or gal is serious buyer. Because that means pro money is starting to look at this stuff. And then you should kind of start thinking about taking some chips off the table, just because a lot of it is timing and cycles. And right now, small businesses are sort of hot, right? I'm participating in it on the buy side. I'm buying small businesses. That's pretty hot. Who knows how long that will be? But right now, that's kind of the neat asset class. For the 10 years before it, it was venture, right? When money was free, it was venture. So there are cycles to it. So to me, it was speed plus big check dollars plus wanting to win equaled Matt chooses big private equity buyout. Now, did I need to sell the whole company, or a majority of the company? Maybe not. So that's why I use up my therapy time dealing with the regret of it.
Okay, we'll get back to majority versus minority raise in a moment. But I think a lot of our listeners may identify with being courted. And to your point, some of the calls they're getting right now are kind of inbound, sleazy, not legit. But others are real legit, especially if they're in a hot industry, if they're in HVAC or plumbing or some home services industry, which is getting rolled by private equity. It's not uncommon for them to get a call once every couple of weeks from somebody who's saying, we're doing a roll up in your industry. So I think a lot of our listeners might identify with that. Walk us through how you evaluated the various private equity companies you met with. You met with several. What were those meetings like, and how did you pick the one you did?
Yeah, it was a three vectors, which, by the way, how I'm about to describe it isn't necessarily how I would say an HVAC contractor in Indianapolis who's got 15 million of top line to do. This is just how Matt did it when he was the founder of a consumer-focused, remember, I was a consumer-focused business, right? So very big difference there. But how I did it, there was really 3 things. The first one is the asshole factor. Like the guy or gal that I was dealing with from that company, were they a dick? If they were, I don't care how rich or deep-pocketed or what their Rolodex looked like. Like I remember several meetings walking out of thinking to myself, and I had a business partner at the time who was more like my financial business partner. And I remember looking at Ken, I'm like, I don't want to talk to that guy ever again. Or like the opposite was sort of true. We'd leave a meeting and Ken would look at me. He's like, can you imagine that guy calling you when something doesn't go great? Right? Because it's all puppy dogs and rainbows when everything's magical. But the second something goes south is when their true colors come out. And you could tell that in the courtship process. That was number 1. Number 2, in my instance, consumer focus. It's sort of, what have you done for me lately? So what were their other brands that they've worked with in the past? Because essentially they're just going to be giving you a playbook. Who have they worked with develops who their reputation is. So and in my instance, Catterton was one of the most prestigious in restaurants. So I was fortunate to work with them. And then the third thing, which I guess is a little bit, it might not matter if you're selling the whole company, but in my instance, it mattered because I was staying on, and that was the vision of what they wanted the company to do. So in other words, when are they going to get a return? So you really got to ask your private equity buyers, okay, great. If you're buying this from me from blank times, who are you going to be selling it to and when and for what multiple? Because I need to make sure that's realistic. Because otherwise, they're just going to cram you down at some point, whether it's in the negotiation or after the fact or with a preferred return or something. So if it's one of those things that if it seems too good to be true, they're offering me 50,000 times EBITDA. Well, that's going to come to roost somewhere. You just got to find out how it went. So anyways, kind of recap those 3. It was a-hole factor, right? who their brands were and were they reputable, like what sort of what playbooks have they run, and then third is like was their vision for how I wanted to grow it the same as theirs. And with Catterton, they checked all those boxes.
Got it. So you want to hear, we want to hold for 7 years. We think we can 3x the value of this company and exit to this brand down the road. And you got to pressure check those numbers and say, yeah, that sounds realistic, or that's like, no, there's no way.
If you're staying around, if you're rolling equity. Now, if you're selling the whole thing, do whatever you want for it. Take the highest price. But every seller is different, right? Every seller has a different thing that they think is important. Some seller may say, I'm going to sell you this business as long as you never change the name. Which would make sense, right? If your name is on the door, or your dad or your grandma started the business, right?
Sure.
But just know that there's no blueprint for this, guys and gals. It's whatever you as the seller want, you should get. If you want the name to be on the door that's yours, put that into the docs and make sure that the folks that are buying the business adhere to that.
So you, along with L Catterton, you also spoke with several other private equity groups. Did you get to an LOI or letter of intent from other groups?
I did.
Like how many letters of intent did you get?
4, either verbal or on paper. And it just so happened that not only was, I joked that not only was Catterton the girl that I wanted to marry, but they were the girl with the richest dad. Like they made the best offer too. So for me, the stars aligned, right? Because it was.
And so what made it the best? Just like what was the structure? And
pure top valuation, $44 million valuation, post-money valuation.
Got it. So if I'm going, it's like 3 times revenue.
Restaurants, it's tough again because fast growth versus no growth, and I know a lot of your listeners might have businesses that have been around for decades. This is different because it was fast growth. It was more closer to like venture style, but from a pure numbers perspective, I think I remember seeing in the LOI something like 12 times EBITDA. But again, EBITDA didn't really matter for us because we were growing so much. Everything is really all pegged to whatever the public company comp is. Because that's the greatest fool, is the public company. I'm serious. So in other words, if someone's offering you 12 times, but the public comp is trading for 10 times, something's backwards in that equation. So in restaurants, it's usually 5 times for sort of like 5 times profit for sort of like subscale, so sort of like sub $20 million. And then as you move along the line, it grows so that it ultimately gets to whatever Starbucks and Chipotle are trading at, which I think I checked recently, like 40 times. Meaning that's where the multiple expansion happened. That's why you really got to ask, what are they going to do with it after they sell it?
Right. So kind of a subscale, you'd expect 5 times, but you were getting offered 12 times, or arguably more, depending on how you normalize.
Yeah, again, with fast, and I see this a lot when I invest in businesses too, or even as I'm looking to buy them. There's always a dance between projected revenue and earnings, and last year and TTM, and there's something in between. And ultimately what determines a market is everyone triangulating around what's the in-between. Because the founder is always going to want based on projections. I'm going to open these 17 stores and they're all going to do great, right? You think all these sellers I talk to, I talked to, ironically, a restaurant seller today. Oh, we're going to open in this market. Well, you still got to go do that, right? Mm-hmm. And then the buyer typically wants based on the most accurate thing they have, which is the 12 months, like the previous calendar year before that, right? So it usually ends up being somewhere in between. In the instance of my deal, again, fast growth company versus legacy Main Street business, my triangulation happened by 3 or 4 other offers. So I got valuations from 3 or 4 different private equity firms. So to me, that was where it all triangulated against.
That's super helpful. For my listeners, TTM stands for trailing 12 months. If you're just following along and wanted to have that decoded, talk to me about the low ball. So 44 million post money was the high end. What was the low end?
I almost said the name of the group. They don't exist anymore, which is ironic. 28 or 29.
Okay. So not a huge delta between low and high. Like 25% difference, 30% difference. I don't know.
It seems like all the difference in the world. 20 to 44 right. is pretty big.
Yeah, okay, sure.
To me, it's less about the what is the actual delta and more about what is your view on the universe and the way that they were looking at the price at the time. Again, remember, I sold at the peak. Yay me, right? I was the hot girl at the dance. So I had the luxury of choice. Sometimes sellers don't have the luxury of choice. I made an offer over the weekend to a small business, and the woman wrote back this morning through her brokerage. She didn't even counter. And the partner that I was doing with, he texted me right away. He's like, "Right, they didn't even counter. Can you believe them?" I'm like, it's early in the game. We're her first offer. She wants what we offered her $1.5 million for her business. She wants 2.5. Maybe it's worth that. I don't know. Maybe it's worth $4 jillion. I just think it's worth $1.5 million. So I wasn't insulted that she didn't counter me. Let time play out. Let her talk to some other people, because it's not about being right or wrong. It's about the seller should get what they want. And if this seller wants 2.5, it's not coming from me. But if you think you can get it, go try to get it. I'm not saying you can't. It's just not coming from me.
So well said. Okay, so let's go back to your deal. So
sorry, I go all over the place on all this.
No, this is great. So $44 million post money. I've heard that term, but I have no idea what it means. So it's just to define.
A lot of your sellers won't deal with a post money because they'll just deal with the total EV, enterprise value, or equity value, depending on who you ask. And the reason why post money comes up in growth businesses is because that implies there's some amount of money that's being put onto the balance sheet to grow it.
So not in the founder's pocket, but onto the balance sheet of the company.
Correct. So in the instance of this one, it started with Catterton valued the business at $29 million, but they were going to then, the total deal was 25. They were putting $15 million onto the balance sheet. So that's where you get 29 plus 15, 44. So that's the post money. And then everything works from there. In the instance of your sellers, they just care about the total EV, total enterprise value.
Got it. So they were saying it. So they said it was worth $29 million, plus they were going to put $15 million on the balance sheet to grow, to open these 8 extra stores. Correct. And many more after that. Got it. That makes total sense. So they valued the company at $29 million. And did they write you a check personally for $29 million, or do they ask you to roll some equity? Like, what was the structure there?
So in this instance, the deal, everything, I remember the head of Catterton, John Owsley, he says to me, and I still think about this a lot, because it all starts with the value of the jewel. So in this instance, the jewel was worth $29 million, and then they layered on 15. Same thing with your sellers. Same thing with this lady in, I almost said where she's based today, where I offered her 1.5. She says she wants 2.5. All the details and machinations and rolling and not rolling and seller note and all that all sort of falls by the wayside. It's really about that headline price. It's what's the enterprise worth? And then from there, it's how is it all mashed up. So in this instance, it was worth $44 million after putting money on the balance sheet. Catterton said, hey, you know what? We're then going to take $10 million and buy up some equity from everyone. Then it's just a matter of how much are you rolling. But to kind of save the machinations, I went from owning about half of the business to owning what I own now, which is about 15% or 16% of the company. But what Catterton did was they ended up basically just buying 60% of everybody's ownership. So I rolled 40% of what I owned. So if I owned 100 shares on the day before it closed, they bought 60 of them, and then I rolled 40. So I rolled 40%. So basically, Catterton bought 60% of the company. And your sellers will know this because this sort of comes back when they say, oh, we want you to roll 10%. We want you to roll 15%. Or we want you to roll 25%. Same thing here. I rolled 40% like a dummy.
I want to get to why you think that was a dummy, but I just want to do the math. And again, if I'm getting into territory you're uncomfortable with, just say, I can't talk about that. But if I'm doing the math right, they valued the company at $29 million pre-money and $44 post, right?
Mm-hmm.
You owned half of it. So they thought your holding was worth around 15 million bucks, give or take.
Correct. Should I have sold the whole thing for $29 million? Yes. Then I would have put 15 million into the bank based on that math. Yes.
Got it. But they said, hey, we're not going to give you a check for 15 million because we want you to stick around of the vision, blah, blah, blah. So here's a check for 60% of 15. And we want you to roll 40%. Is that basically the math I should think about?
Yep.
Okay. So you're in, you got some cash in your jeans, but they've asked you to stick around.
Correct.
And
I took cash 40%. I took cash out. Yes.
Yeah.
But to me, it wasn't about the cash out. It was about the roll.
Because you thought that was going to be huge.
Thought.
Okay. So
yeah, but that's the thing. That's the thing. And this is the thing. I gave up control, and I should have just sold the whole thing.
Was that on the table? Did L Catterton like offer 100%?
No, it wasn't really common in our industry that founder-led concepts that were that nascent, were fully cashing out. Although there was one or two, Snooze AM Eatery being one of them. Although, my therapist reminds me that, like you said, like it wasn't really. I can't think to myself about taking 15 million out, like, and being done, like, because that really wasn't an option. But to specifically answer your question, it probably wouldn't have been possible because I was so inextricably linked to the company. And I see this now when I'm buying businesses. I was looking at a restoration company. This dude wanted he wanted to cash out. I'm like, but bro, you are the business. Like, and that's probably true a lot of your listeners. They are the business. So from a security of the buyer's perspective, they need to have that guy roll or gal roll a little bit. But in any event, so I gave up control, sold 60%. But yes, I wish that I had just sold more of a percentage because then I would have had more cash out at close. Because the roll right now the roll is worth nothing, but it may be worth lots because the business is actually doing well. But it's just out of my control, and it's not what I thought it was going to be when I rolled. Where's your? I see your face. What was your face making that look for?
I've got like 1,000 questions. So I'll try to think about them.
Well, I'm like Lionel Richie. I'm here all night long. So what?
Lionel Richie. Only a portion of our listeners will get that reference, but those who do will smile. Okay, so let's dig in. So they wanted you to roll equity, and I'm assuming stay on as the CEO and driving force of the business.
Yeah, they gave me a big salary and everything.
Okay, but you lost control. What was that like in the first few months as a minority shareholder, yet the CEO of this business?
It sucked. Now, again, it sucked for me. It doesn't mean it sucks for everyone, right? Especially as that
it sucked.
I had a boss. I hadn't had a boss before, at least not in the history of running Protein Bar. And now all of a sudden I'm a boss. Here's one. I distilled this down maybe like 2 months ago because someone once said to me, well, the day you closed, the plan wasn't different. Like, it's not like all of a sudden I changed our strategy. And what I said was, the difference is the day before I closed, I had a vision. The day after I closed, I had an underwriting plan. Very different things. An underwriting plan is a bunch of fake numbers to get to even more fake numbers in the future. A vision is seeing the future and working backwards to get there. The strategy was no different. The underwriting plan was built on the strategy in my head and the strategy we all agreed to, but it became a plan. It became a thing. And the margin for error, here's what I mean. So the underwriting plan meant that 9 out of my 10 stores had to do well. Well, I had 7 did well. So that messes up. Think about like a nerdy private equity spreadsheet with like all the cells linked, right? You mess with one cell and it's like this cascading effect of changes. That's an underwriting plan. If you're not priced to, or if you don't execute to perfection, everything is off. And I'm not saying that's true 100% of time of private equity. I'm just saying it was true of 100% of time for me. It was off. They priced to perfection. And unfortunately, I did not perform to perfection. I got fired a year later, which I deserved. For like 72 hours, it was like the worst thing that had ever happened to me. And then it has become the best thing that ever happened to me. Again, through years of therapy and psychedelic drugs.
So, okay. So like, tell the story of getting fired if you don't mind. I mean, like, did it like walk me through what led up to the actual day and how did they handle it?
Deal closed. Catterton invests $25 million October 1st, 2013. I got fired November 19th of 14. So almost a year later, right? So it was a very precipitous decline for a year. The long and the short of it was I just made bad mistakes. And to Catterton's credit, they come to me a few months after they invested in the deal and they're like, Matt, you clearly need some help. When we underwrote this, the underwriting plan, when we underwrote this, we didn't think you were the problem. We thought there were some other people the problem. Turns out you're the problem. They didn't say that, but that's what was reality. And they said, do you want us to hire you a really good operations person to be your number two? Or on the other end, do you want us to hire you a CEO to replace you? Or do you want something in the middle, like a president who aspires to be the CEO? And I said, let's do that. So we hired the best headhunting person in the industry. We did an exhaustive search, and all 8 of us on the board agreed to hire this one gentleman. And he just was a bad fit, right? But he came in, replaced me. And to be fair, I at that time was sort of persona non grata anyways.
With who?
With Catterton, the owner of the business, just because for the previous 6 months, I had opened a couple bad units and things weren't performing to their underwriting plan. But this gentleman that we had hired was doing great. And he was starting to make all the decisions. I knew my role was changing, so I flew out to Greenwich. I fly out to Greenwich because I knew my role with Protein Bar was changing because this Samir gentleman had been hired to replace me. And at the time, he was doing great. So I fly out and I rent a car, drive up to Greenwich. I show up around 11 o'clock and I go to John Owsley's office and he grabs his jacket and his keys. He's like, oh, let's get out of here. And I laugh. I'm like, oh, this is like that scene on Jerry Maguire where Bob Sugar takes Jerry to the busy restaurant and they fires him. And he like giggles, right? 20 minutes later, that was what was happening. So we're sitting in a Le Pain Quotidien in downtown Greenwich. And fortunately, it wasn't a crowded restaurant, but we sit down and he asks how Samir is doing. I said, Samir's doing great. And he says, well, how are you doing? And I wept what seemed like for 5 minutes. And he's like, okay, well, great. Well, why don't you take a quarter off, which is what he said. But Catterton always likes to remind me, Matt, we didn't fire you. We just asked you to take some time. They fired me. So anyways, I took some time off and came back and they just didn't have need for me, which was fine.
When you say you wept in the restaurant, do you mean literally or were you?
Literally. In fact, this young woman sitting in the corner sends over a cupcake. And on the napkin, I have it in my box of memories somewhere. It said something like, your eyes are too pretty to be clouded with tears or something like that. And I kind of took that as a sign from God that everything was going to be okay. Here I am getting fired from the company that I started. And this random lady sends me a cupcake with a note, And it was right. Everything turned out fine.
What made you so emotional in that meeting? You strike me as the kind of guy that, like water off a duck's back, like things are going to be fine. You got this president guy, he's doing okay. Like, what was it that made you so emotional in that meeting?
The first thing that was going through my head was that I'm not Mark Zuckerberg. Why couldn't I be Mark Zuckerberg? Why couldn't I be Jeff Bezos? Why couldn't I be Howard Schultz? Why couldn't I be, no one knew who Elon Musk was at the time, but why couldn't I be Elon Musk? Why couldn't I be all these founders that had accelerated their business to great heights and had stayed there along the way for the journey? What's wrong with me? So that was why I was emotional, because I wasn't those guys. And it's just taken me a while of therapy to realize I'm just not those guys or gals, Sarah Blakely. I'm not Sarah Blakely. I'm just not, unfortunately. I'm Matt Matros. So that was why I was emotional. Because I felt like I'd let them down or there was something wrong with me.
And what was your...
I know this is changing the whole... This is like the therapy hour now with John and Matt's therapy hour versus...
Yeah. Hey, man, my fees are way less than whatever you're paying your therapy for. So your therapist, so we're good. You're the partner at the private equity group who took you to lunch. What was... It sounds... the way you describe it, collegial, like, hey, arm around the shoulder, why don't you take a couple of months off and reflect a little? Like, he didn't like slam his fist down on the table and say, that's it, Matt, you're gone. Like, he was much more collegial about it.
Yeah. Which is why I have to give them credit.
Yeah.
They could have been bigger jerks about it. Their big investment had gone sideways.
What happened to your salary?
I mean, I got fired. My salary got put back into G&A.
So after the 3-month window, they said, like, I think it's better.
After the 3 months, so I ended up taking time off and traveled around the world. It's amazing. Came back. And then Samir wanted me to go do a bunch of stuff. He's like, great, you're back. Let's get you reinvigorated into the business. The things they wanted me to do I just didn't really want to go do, for lack of better expression. I kind of had moved on.
Yeah.
So then,
yeah.
Then we parted.
Okay, so your salary stops, but what happens to the 40% of the equity that you rolled?
I got a stock certificate in my safe right now. You want to go grab it? It's a piece of paper. I mean, I'm still on the cap table, still the second largest shareholder. And they've had subsequent fundraisings and financing since. But now I'm just an investor.
And what influence do you have over the company as an investor? For example, are you a board member or?
I was a board member for the longest time. My third business was a video shopping startup that I exited to QVC. And as part of me going to work for QVC, a public company, I had to quit all but one board seat. And I ended up staying on the board of a fintech company instead of Protein Bar. So I resigned from the board. But no, I have zero influence. I'm a customer. I texted the CEO last week because we opened at O'Hare. It was awesome. We're going to open at LaGuardia, which is my home airport. I'll show up when I'm flying Delta, buy some shakes, but no, I have zero influence.
And
it sucks.
How has the value of the 40% evolved? So again, when you rolled it, theoretically, it would have been, I guess it was half. What do we say? 50% of 29 million is 14.5. So 40% of 14.5 is 6-ish. Mm-hmm. How has that evolved? Do you think it's still worth 6?
No, it's not. It's worthless.
In what way?
Well, it's only worth what someone's willing to pay for the business. And I just don't think the business is... Well, first of all, the business isn't saleable in its current state. One. And then 2, even if it were saleable in its current state, well, any business is saleable, but like, even if it were, Catterton put so much money into it, they have what's called a preferred return. There's another thing that the sellers need to be aware of is what's called LIQ LIQ preference, liquidity preference. You may get the valuation they want, but the buyer may say, great, but I want 5 times my money back first. So sure, here's a gajillion dollar valuation, but it doesn't matter if I'm going to get the first half a gajillion before you even get a penny. So the point being is that Catterton has a liquidity preference.
And what is their liquidity preference?
It's based on a rate of return when they invested and things of the like. But it's just a pretty high number. Like, so in other words, we'd have to sell the business for a lot in order for my equity to be worth something. Which it's possible. It's not. It's a greater than zero chance.
I want to make sure everybody listening understands that. So, it's not like they could sell the business. I'm just going to make these numbers up for 10 million. You own 10% of it, so you get $1 million. That's not the math. What the math is if they sold for 10, they might say, yeah, but we put 50 in, and so you get nothing because we can't get our preferred return because we only sold it for 10.
Correct.
Just making these numbers
exactly.
up.
It's a waterfall of funds, right? So in any investment deal, 9 times out of 10, probably 100 times out of 100 is the last money that gets put in is the first money that comes out. So they put 25 million in. So the first 25 has to go to them. So that's immediately we have to clear a $25 million valuation. And then that 25 has been accruing interest for now 12 years or coming up on 12 years, right? Plus they put some capital in cents, plus.
Yeah.
That's my point.
And so
is that it could sell, but the preferred equity is preferred. They get the first bite of the apple or first whatever. They get the first money out, and then what's ever left is what's shared by the common shareholders, of which I'm the biggest.
Makes sense, and obviously a cautionary tale.
I was going to say your sellers may not deal with this because in your sellers in most of these small businesses that are what we're talking about, sort of in that 5 to 15 or 20 of revenue, there's really only going to be 2 investors, a general partner and a limited partner. There's going to be the seller and the role. Like everybody's going to kind of have the same class of stock. That being said, in a downside scenario, if the seller rolls equity, it's not free. Like that's what you're rolling equity. You guys still go work to go do the stuff to make the equity worth something. And if it's not, then you're not getting anything for it. So that's why when we talked earlier, like if I had to do it all over again, would I have sold some amount higher than 60? Absolutely, with the luxury of hindsight.
Yeah, it's such an important point for many of our listeners because in many cases they are being approached by private equity and professional money, so to speak, and some of them have some of the term sheets do have liquidity preferences. So understanding that, and talk to your advisor, talk to an accountant, and really understand what that means, because as Matt's pointing out, it's a big deal.
Just remember, private equity is great, right? They've made lots of people rich, and there are many private equity billionaires, this and that. But don't forget, private equity is not undefeated. They make mistakes too. In fact, their entire business is predicated on being right just 1 out of like 5 or 6 times. That's it. Venture capital is even worse. You just got to be right 1 out of 20. That means 19 of their investments go to squat. 1 is a big grand slam. Private equity is similar math, just with a lower quantum of failures. They make 5 or 6 investments. They hope one of them is a grand slam. 3 or 4 of them will be maybe 2 are failures. But even if they make 5 investments and 1's a grand slam and 5 are failures, they got 1 grand slam. Mm-hmm. Point is your business may be the failure. Just because it's some hoity-toity private equity firm with like shiny shoes and doesn't mean they're undefeated, is all I'm saying. Now, it's not their fault that Protein Bar was one of the failures. But I will tell you, it was also not entirely not their fault. I joked that it was 51-49. 51, and depending on the day, are they 51 or am I 51?
Have you kept in touch with, obviously you're still a shareholder, so there's some degree of communication, but do you continue a relationship in any form?
With the CEO, yeah. And with the existing investors, I do. Because the existing investors were my people. They were the people who I met in the restaurants that were traders and bankers and lawyers in Chicago that fell in love with Protein Bucks. They were customers. Catterton, we'll talk on occasion. I don't really have a reason to communicate with them, although incidentally, I've offered to buy the company back several times over the last few years. To varying degree, to no degrees of success because I haven't bought it back, but to varying levels of interest on their part. But I just got to make peace with it and move on, right? Because that's like gave up control. That's what it all just comes down to. Gave up control. Tomorrow they could change the name to, carbohydrate bar. I can't say anything about it. They do things all the time I see on social media that I think is pretty boneheaded, but they also do some things on social media that's pretty awesome. But it's not my business.
Yeah. Yeah. Protein bar is actually a pretty good name, I think. But
there's love-hate with Protein Bar. Another thing we did wrong. The guy that replaced me opened a new unit calling it Thrive 360. It was a huge failure, wasted millions of dollars. But anywho, that's another therapy story.
That's another lesson for another day. Your investors, you owned at the time of the Catterton investment 50%, but you had other investors, these traders and people. Were they treated the same as you? In other words, they're waiting for their money.
They're all the same as me. Yep. Yeah. In fact, my LLC structure, my operating agreement, of which they all subscribe to as investors, said that we all needed to be treated the same. So I sold 60% of my shares and they all sold 60%. Now, many of them didn't want to. Mark Cuban, he was an investor of ours. He famously did not want us to, by famously, I mean famously to me, did not want to sell to Catterton.
What was his objection?
Twofold. One, he just doesn't like big institution. And two, he kind of liked what we were doing. And I said, great, why don't you write the check? And it was crickets. Not to say that he couldn't or wouldn't have. He's not he wasn't a big restaurant investor, but that was what I was doing. He's like, just keep raising from us being defined as our existing investors. And but they were putting 25 million in. So
and how did that impact your relationship with those individuals?
I took it pretty seriously when I took money from people. Like, the game changed when I took investor money on. Now, obviously, a lot of the folks listening to this don't have investors. It's their company. But everything changes when you take someone else's dollars. I mean, literally, you have a fiduciary responsibility. So all the things that come from having a fiduciary responsibility. But it was different. And that's why I knew not to take money from friends, which I didn't. I was very smart. With Protein Bar, I didn't take any money from friends until very late, like the last round or something. I took like 10 grand from a few friends. But to answer your question, I mean, it changed. The relationship changed. But anytime you introduce money into a relationship, it will change. It just does.
I guess I was specifically interested in how the decision to sell to Catterton, if I'm understanding the math correctly, they were paid as shareholders 60% of the value of their.
It all depended on when they came in. Part of the reason why Cuban was pissed was because he had invested 13 months prior. So his return wasn't all that great. I mean, it's still a return. I mean, he made money on the deal and he rolled equity. Ken Leonard, my first investor, made many multiples on his first investment. And the second round investors made many, many multiples, and so on and so on. It really just depended on when did you enter? At what price did you buy the stock, basically?
Mm-hmm. Got it.
Yeah.
Got it.
Most of my investors got all of their money back and then some, and got free equity, or not free, and got equity in the business. So basically got all the money back and a return, and are playing with the house's money, is the expression.
Yeah. Yeah. But you waiting in line that hopefully one day this thing will be worth the truckload and the liquidity preference will be.
Some people are waiting more patiently than others. I'm kind of like not really waiting. I'm just doing other stuff, and call me if it happens. It'd be great if it does, but not counting on it.
Yeah. Because you're up to some other cool stuff. So describe what you're doing now, because you've had a couple of other exits, one to QVC or the parent company of QVC, another to the guys behind Keurig Dr. Pepper Limitless, which is a cool caffeine drink that many people will be familiar with. So you've had some other tremendous successes, but now you're acquiring businesses. Maybe walk us through your thesis there.
Yeah, I like to say what I'm doing right now is I'm co-piloting. So I'm either co-piloting a seller who's selling their business for the first time. And although I'm on the buy side of it, so I'm not on their side, at the end of the day, it really matters what they want. So I'm trying to shepherd to get to what they want. And then also bringing in an operator to operate the business. So what I do is I identify companies that I want to buy, either because I feel like I have an edge or I have an interest or I'm particularly bullish on a category. I then work with the seller to get the deal that they want. I find an operator to run it. And all the while, I'm working on getting capital lined up, either for myself, my friends, or other family offices that I work with. I guess you would call it an independent sponsor of sorts. Mm-hmm. But in reality, I like being the number 2 guy. I was the number 1 for a long time. And if you've heard me say the word therapy on this call, that's why I don't like being the number 1 anymore, at least for me. So I like being the number 2. So I'm helping to put first-time business owners or very serious executives who've never owned a business but are really good operators into the driver's seat and being their co-pilot. I'm doing this sort of informally. I don't really have a website or anything. It's just, I'm finding deals either on market or off market, and working with the sellers to get them what they want.
It's awesome. And maybe just walk through how people can find you if they wanted to reach out on social. Are you more of a LinkedIn guy?
I love LinkedIn. On May 30th last year, I said I was going to post once a day for a year, and I did. And now I post pretty much every day. Matt Matros, just find me. There's a famous poker player named Matt Matros. I'm not that guy. I'm the better looking Matt Matros. But yeah, I'm on LinkedIn. It's, I guess /Matt Matros. So MATT and then MATROS. It's me. I'm pretty reachable.
And we'll put Matt's profile in the show notes at builttosell.com. Matt Matros, thanks for doing this.
Thank you. I appreciate it. It's awesome.